Yeah, so we are seeing some impact on energy production facilities, mostly on the natural gas side, where the largest liquefied natural gas production facility of the world in Qatar is currently not producing. On the oil side, there have been reports of production cuts on the refined product side in Saudi Arabia's largest refinery, producing around 0.6 million barrels per day, and also reports about a more modest 0.2 million barrels per day potentially reported drop in Iraqi production. So on the oil market, it's still mostly about a very large shock to exports, to flows, whereas on the natural gas market, it's not only currently a large shock to exports, it's also a very large shock to production. And one critical point is that the impact on sort of the fair value of oil prices critically depends on the length of the disruptions to the flows to the Strait of Hormuz. Because if the flows were to recover, for instance, in a week or so, the actual damage to production would be limited because producers would be able to store their barrels, export less now, but export more later once the strait reopens. However, if you were to see significantly longer disruption, storage facility constraints would likely be hit, and larger production cuts may be well required. Moreover, if you were to see very sustained disruptions to the Strait of Hormuz, because you cannot draw inventories forever, prices may have to rise more substantially to incentivize oil demand destruction. So the key point is the impact on prices is a non-linear sort of convex function of the length of the disruption to the flows of the Strait of Hormuz.
Indeed, I hear you, time-based. Listen, I want to get back to oil, crude, and the Strait of Hormuz, alternatives to it in just a bit. But while we're talking about nat gas here, I think it's worth reminding viewers that, you know, it's not just about oil. About a fifth of the world's natural gas also goes through the Strait of Hormuz. And this is a market, correct me if I'm wrong, Dan, where people see less risk because it's more regionalized. Gas markets are more diversified. You've got supplies from Russia, Norway, also obviously the U.S., greater storage capacity, and also rerouting possibilities around south, around the Cape of Good Hope, which is very different from oil, from crude, yes?
So yes, gas markets are much more regionalized than the global crude market. And yes, U.S. natural gas prices are somewhat more immune to developments in the Middle East because the U.S. is essentially exporting all the gas that it can export. LNG exports are essentially at their constraint at full capacity. However, the upside to European and Asian gas prices, to LNG gas prices from sustained disruptions to flows in the Strait of Hormuz is even larger than the upside to oil prices. I think one key intuition is that storage levels for natural gas in Europe are already quite low. And second, we are seeing actual large cuts in production to LNG production in Qatar. And so we estimate that if you were to see a 1-month disruption to LNG flows to the Strait of Hormuz, prices may rise by more than 100%, because you may need to see LNG prices going back to the high levels that triggered demand destruction for natural gas during the 2022 European energy crisis. So very significant upside risk in Asia and Europe, but more immune in the U.S.
Yeah. And that's because there's a significant more upside for Asian and Europe, not so much for the U.S. and natural gas prices, because the U.S. is the exporting country of natural gas.
That's right. They're basically self-sufficient. They produce their own consumption, exports are already at their full capacity. And so even if there were a big increase in global LNG prices, the U.S. could not export more because you're already at full capacity. So you wouldn't create local tightness in the U.S. market because you're already exporting everything you can.
Yeah, so the U.S. has its own buffer there. Let's go back to crude oil really quickly, Dan. And Obviously, we spent some time yesterday talking about the market implications from the U.S.-Israel strikes on Iran, and the consensus that we've been getting throughout that 4-hour live show is that, you know what, this doesn't really hurt China, especially when it comes to the market narrative around, oh, this is about China. This is, you know, a country, Iran is a country that China has been exporting cheap oils from. Well, the consensus that we got from two of the guests was that, you know what, it doesn't hurt China because oil is fungible and China has been diversifying its oil supply sources. Number one, do you agree with that? And number two, then does China play any role? Is China a factor in moving the oil markets other than the fact that it actually consumes a lot of it?
Yes, oil is largely fungible. I would agree with that. Now, at a macro level, while China has very abundant supply of renewables, coal, many metals, China still imports about 3/4 of its oil consumption, around 17 million barrels per day of China oil consumption. And so higher oil prices, no matter what the driver is of the increase in oil prices, are still a negative for real incomes and for the terms of trade for China. But yes, China has been diversifying its crude imports, and China has been accumulating. We estimate that China currently has accumulated around 110 days of crude inventories in terms of days of demand covered. In contrast to many other regions in the world, China has been increasing inventories over the last couple of years where prices were relatively low. So that's a helpful buffer in case we were to see sustained upside to prices and more significant scarcity.
And when it comes to Iran, and I know that there are a lot of questions around the leadership and so on, but if it becomes a better functioning state with sanctions coming off its back, perhaps in the medium to longer term, this is a bearish scenario for oil, I would imagine. Does that bring down your fair price of $65 with all the other factors as staying constant?
Yes, it's an important reminder that the geopolitical risks to oil prices are two-sided. On net skew to the upside, because it's easier to imagine a very large drop in production than a very large rise. But yes, there are also geopolitical downside risks to oil prices. Specifically, we estimate that in a scenario where sanctions on Iran would come off, perhaps in the context of a deal, of a nuclear deal, that Iranian production, would edge higher from the current sort of 3.5 million barrels per day level for crude. And this, in combination with the release of roughly 100 million barrels of Iranian sanctioned crude that's currently floating on the ocean, that's stuck and that could reach markets, that those two effects, somewhat higher production and more availability of oil that's currently trapped on the oceans, that could cause maybe $4 or $5 of downside to the fair value of oil prices. But that's a modest downside compared to the very significant upside in scenarios with sustained supply disruptions.
You know, the prospect, Dan, of all this oil being literally released or let free, is that the reason why the oil market right now is in backwardation? I mean, before the strikes, it was in sort of mild backwardation, but obviously now we're steepening it. I mean, is that the sort of outcome that traders are pricing?
Yeah, I think traders are pricing both a base case of significant draws in oil inventories in coming weeks, as a lot of the barrels are likely to be trapped in the Middle East, and so draws elsewhere in the world. Plus, I think a compensation, a risk premium for the possibility that that you may see supply disruptions for longer. And so that creates a bid on barrels you can get, and that makes the spot barrels today more expensive compared to barrels 3 or 6 or 9 months from now.
Indeed, and one reason for that is, with the official closure of the Strait of Hormuz and the actual closure, because not much is moving there through there in any case, right? Folks are looking for alternatives. They do exist. The UAE, the Saudis have it as well. But, in terms of what can go through these alternative routes, I've seen some estimates anywhere from 13 to 20 million barrels go through the Strait of Hormuz, but both of those other alternative routes would account for, a maximum 3%? So it's going to help, but only at the margins, yes?
Yeah, so that's right. When you look at crude markets specifically, in normal times, the exports of crude through the Strait of Hormuz are around 16 million barrels per day. Spare pipeline capacity, primarily concentrated in Saudi Arabia and the UAE, is estimated at just above 4 million barrels per day by the International Energy Agency. So that still leaves potentially 12 million barrels per day of crude exports at risk. And so this pipeline capacity that allows you to bypass the strait, is helpful, especially if you were to see partial drops, partial closure and partial drops in volumes. But with the current magnitude of the decline in the strait, you're still left with 11, 12 million barrels per day of drop in net exports, whether it's via pipes or via the sea to the rest of the world. And so that's creating tightness in markets outside of the Middle East.